All right, it's 11 o'clock. Hey, just going to get started. Hello, GumboNation. And this is our weekly, believe I'm going to start this because I think now more than ever it's going to be critical, and I say the word critical, to make sure that you have the information necessary on what's going on in our market, right? So, today's State of the Market is going to answer some questions on interest rates. You'll be hearing me talk about in the future, inflation, where's that going, and some different things like that. So with that being said, look, if you've got any questions that you need answer to, hey, the phone number's up there. You can call me day job there, 504-207-7600. Also, I understand people get rocking and rolling, and my whole goal here, and what the whole goal of Mortgage Gumbo has been for the last 7.5 plus years, I'll be 8 years having top most listened to live show in my time slots on Saturday, is to provide education and options. And that QR code right there, if you click on that, that's going to take you straight to Mortgage Gumbo TV on YouTube, where you can subscribe to that. Look, there's over 300 podcasts that are there. You could also click on past shows on mortgagegumbo.com to get that information as well. I think it's important now more than ever. You're going to have resources out there on where you can get your information from. So with that being said, just want to kind of get started here and just kind of give you my overall opinion and just take a few minutes today really just to share my thoughts. I get questions daily on, what's going on with these interest rates. What's the deal, especially in the last 45 days. Should I wait? So let's address that. And my goal is to share with you a very high mountaintop sort of overview in just a few minutes, because I know everybody's got business to do, and that's fine. So I want to get you back to doing what you do and rocking and rolling. But I also want to make sure that I break it down to where it can be understood. And number one, folks, is inflation is real. And I'm going to talk in depth next week for inflation. So we'll get into that. And that is the primary reason why you're seeing rates moving in a direction, quite frankly, that we do not like, right? And so that's why we're going to discuss that next week and kind of go through that. The other word that you're going to start seeing is, and if we played buzzword bingo here, I'll pop it up for you, and that is recession. And just to kind of read the definition here, a period in which the gross domestic product, GDP, the amount of, which is the amount a country produces and sells, declines for 2 or more consecutive financial quarters. Well, we already had it for the first quarter, right? So expectations of this going up for 2 consecutive quarters is there. And quite frankly, I think it's the only way. I think the Fed is pushing us towards a recession because that's the only way they can get a hold. So let's kind of circle back here to and let me give you the whys, right? So on mortgage rates, our feds, right, our friends, a.k.a. puppet masters, no matter what political belief you are, we've lost trust in what they say. Yet, everything that they say holds a ton of value, right? So all last year you heard them talking about the Janet Yellens of the world. Inflation is transitory. Even Jerome Powell, which, by the way, he's speaking at 11:30 today. So when you hang up here, if you want to go find that video, you'll have that also. But inflation is transitory, meaning, it's just going to roll in. Everything will be fine. We have it under control. Well, we're now seeing the opposite of what we saw in 20 and 21, right? In 20 and 21, it was quantitative easing, right? And that's buying mortgage-backed securities and treasuries. To now what we're seeing is quantitative tightening, and that's the selling of these bonds. Now, look, this is something that's been expected. This is something that on Mortgage Gumbo, in my opinion, I think it was delayed by years. But what did the Fed keep doing? They kept buying bonds, right? Which was great. A lot of us in the real estate market benefited from it. People buying houses benefit from it. But home values kept going up while rates were getting less. But guess what the Fed kept doing? They kept extending these forbearances, right, on housing. And to this minute, student loans, if you have a student loan, you haven't made a payment in 2 years. In 2 years. Add that into cutting checks for folks and stimulus this and stimulus 4.877. And the giveaway program has been full steam ahead, right? So the calendar year switches to 2022. And our leaders advise us, listen, stay calm. Ignore the smoke that's, over here, right? Ignore that. Those things such as supply chain issues, labor shortages. But in March, we're going to start with a federal funds rate increase of 0.25. And in every other meeting, we'll look at maybe a slight increase from there. So you go, okay, here we go. Here comes a little bit of the quantitative tightening, and that's fine, right? We can't be at zero forever. So let me reiterate again, because I get calls all the time. Well, the Fed's speaking. I've gotten 5 of them today so far this morning of people going, hey, I want to refinance before the rates go up, or I want to buy before the rates go up. I want you to be educated on this. Understanding that the federal funds rate, this is what banks lend to banks. These are short-term rates, GumboNation. So these are your auto loans, your credit cards, your HELOCs. If you've got HELOCs, you've got so much pain coming. And this is why I've been saying it's Satan and the devil, this program, for as long as I've been on radio. Right? So now what happens? Russia invades Ukraine. Well, Dwayne, I listened to your show, and world strife is supposed to be good for mortgage rates. Yes, under normal circumstances, this is true. Right? Hey, they over there bombing each other, doing what they got to do. Okay. Hey, we'll benefit. Well, guess what? The 10-year did drop a little bit. And then when the Fed quickly learned that we can't keep rates down like this, they learned that 40 years of their credibility of them managing the U.S. economy, they were way, way, way behind the 8 ball. So what does the Fed do? The Fed, regardless of the effects on not just the U.S., but the world economy, is going to act. And so how do they act? Again, what do we say? They puppet masters, right? So now you got Fed presidents saying, instead of them going, hey, we should go up by 0.50, you start hearing 200 to 250 basis points. And when I say 200, that means 2%, right? So, and I know this is nerd stuff, but don't worry, I follow it for you so you don't have to, right? I'm kind of a geek when it comes to this stuff. I take my living pretty seriously here. So these folks it's almost like a contest to see who could be the most hawkish. And what I mean by most hawkish is aggressive, right? It's called hawkish is aggressive. Dovish is where you just kind of sit back. And that's what we were in 20 and 21, right? Very, very dovish. So the 0.25 in the federal funds rate in March comes, and then they say, hey, we may go to 50 basis points. Well, now, folks, they just announced, and I'm sure it's what Jerome Powell's going to discuss in about 20 minutes. Now they're looking at a 50 basis point increase at the May meeting, another 50 basis points in June. Okay? So, are you with me? So, you add that 50 plus 50 is 100. That's 1%. Then the 0.25 that were there is 1.25. But here's what's crazy. They're projecting by the end of the year to raise the federal funds rate to 350 basis points. 3.5% from zero. Well, look at where the rates are today, and we're just talking about all that is right now is 125 basis point. So we have to almost double where we're at today. So what that means is the Fed is sending us into a recession. There's no other way about it. So there's more pain coming. And if you listen to me, you understand that the 10-year mortgage rates are tied to the 10-year treasuries, right? But you've also got, within that 10-year treasury, you've got yields. So when a lot of times the 5-year yield, the 2-year yield, those are looked at as a gauge because it's a lesser measure than mortgage securities, but they've jumped from 155 basis points to 275 just in 5 weeks. So that's 1.2%. So that's why just since January, and I'm going to break it down for you, but just since January, interest rates are up over 1.75% or 175 basis points. What that means is rates exploded. The bond market is getting a royal butt whipping. Okay? A royal butt whipping. And, hey, most of you know, hey, yesterday celebrated my 51st birthday, so no secret here. But when I got into the industry and these numbers were where they were, the interest rates were at 7.25 and went up to 9.75 in 8 months. That's 200 basis points, right at what? 250 basis points in 8 months. We've seen 175 in 5 weeks. That is a ton. That is a ton. So the Charlie Brown teacher, want, comes to mind. That's what you're saying right now. Dude, what does all that mean? All right. So here's the breakdown. All right. Mortgage rates, higher mortgage rates, the bonds known as MBS, mortgage-backed securities, are like any other product that you buy, right? They're sold at a premium. So every single loan, the lender has to purchase a mortgage-backed security. Think of anything on the shelf, right? Whether you're buying it at Dollar General or Neiman Marcus. Somebody has to buy that product and get it on the shelf for you. So whether it's a loaf of bread, gum, a vehicle, and so on. So because the Fed has been so delayed in their approach and responding to, well, everything, nobody knows what to sell or buy mortgage-backed securities for. And then you take it even further, right? Beyond us trying to make a living every day, think about retirements and the end user, right? These are your portfolio managers, the people in charge of making sure that your pensions, your retirement funds have some money. Well, they don't know to put that in there because they don't understand what the market is right now. It's basically, GumboNation, it is basically no man's land right now. No man's land. So let me explain premiums to you. And it's like anything I mentioned. You have a high end and a low end, right? Same thing with mortgage bonds. When a bond is purchased, it has discount points. Think about it this way. Is there any difference between Fruit Loops with Toucan Sam on the box and colored O's in the white box that says cereal? Made in the same factory, just marketed a different way. Well, same thing with bonds right now. Okay? When bonds are purchased, they have discount points. Just like you hear, hey, I've talked about it on the show. Do you want to buy a discount to lower your rate? It's given back to you. But right now, if we as an investor or lender buy something, the discount is at 50 basis points, 0.5%. Versus in 2021, 20 and 2021, listeners, they were getting 300 to 400 basis points. So at 50 basis points, there's not a lot of skin on the bone to share with you, right? Home buyer, refinance, stuff like that. So, I don't know, think of a gas station, right? You put up gas for $1.03, and The gas station across the street on the opposite corner goes 99 cents. So you go, you sucker. Okay. So the last 2 years, there was so much profit to be made and everyone competing for business that homeowners, people refinancing, could take advantage of it. Because us as investors, we were giving that money back to you. Because what else was going on? Forbearance, right? So these investors couldn't collect any premiums, couldn't collect any money. They would get in trouble. Heck, they get in trouble if they even reported it incorrectly on the credit bureau. So they said, you know what? At least the smart ones. And go watch the news. You're seeing a lot of national companies. Some of them that here have branches locally. They're starting to go under because they didn't plan accordingly. But now what you've got is, as forbearance was going on, investors, and especially people like Mortgage Gumbo, because we were direct to Fannie and Freddie and Ginnie Mae, those folks were buying up all the loans. So it's why I have rates that are much better than the person down the street because they sort of got to go through a middleman. So I gave those savings on to you, not only with a lower rate, but then, hey, when rates are high, people want a lower rate. When rates are low, they want even a lower rate. So that circles back up to where we talked about discount points, right? So I could offer you, hey, I could lower your rate from 4.25 or 6% to 3.25. But if you want to buy a point, I could even get it all the way down to 2.875. So you say, hey, that's worth it. Well, now, if I'm offering you 5.25 and I go, hey, I could give you a discount. That discount might take you from 5.25 to 5 1/8. 5% tops because there's no skin on the bone. So the Fed's scrambling because now they've created a product that nobody knows what to buy it for. They can't set a price. So imagine riding a bike. I don't know how many of you have ridden a bike lately. It's been years for me. But what's the saying? Oh, it's as easy as riding a bike. Hey, just get on that bike and rock and roll. Well, 2020 and 2021 was like getting up on a bike and that you hadn't ridden in a while, and it was easy. What was it? All right, I'm going to buy a house, I'm going to get a rate, and I'm going to close my loan. So the false narrative got created with these rates, right? And here's how you may see it. Free checking. You get no money on your checking accounts, right? It's free checking. So riding the bike is like a mortgage rate. You know how to do it. It's always been there, that number to get that number on a piece of paper to get your payment. So you get on, and I tell you, like your hair is on fire, not me personally, obviously, right? But your hair's on fire. I want you to go straight as fast as you can, and everybody gets to race. And no matter where you finish, you win. You win, and you race with confidence. But now what I'm going to do is I'm going to have you come back to the starting line here. It's 2022. Same exact course. But while you were going so fast, you wasn't looking to your left or your right. You wasn't seeing that you were actually on a cliff. And you were just speeding, full speed ahead, right? Because there was no consequence. Go, go, go. Make loans. Do it. Records. Oh, my God, this is incredible. Wow, refinance. House came back $40,000 higher than what I thought it was. But now I ask you to run that race, and I have you put a blindfold on, right? Envision that. Same course. And I have you put a blindfold on, but I tell you, hey, if you go off course or you fall and you don't complete this, you can't compete in this business. So right now, all the investors, they're tempered. So it leads to the perfect storm, right? Inflation. Huge. Recession. We're going to talk about it next week because you need to be familiar with it because it's coming. Federal funds rate rising. But at what pace? Are they going to sit there and just keep talking amongst each other? Now they're admitting to 350 basis points. Can you imagine what it's probably going to go to? Home values way up and, quite frankly, probably a little bit overpriced. And then think of all the bonds that got refinanced. 80% of all the houses that could refinance pretty much did so. So all those bonds at higher came in and got sold back at a much lower premium. So they can't, I'm not going to go buy something at 5.25 that I can, or at, let's say 4.875 that I can only make 50 basis points on. Right? So right now, the mortgage-backed securities just has absolutely no direction. So here's what you're going to see. Your weaker, selfish, greedy lenders who thought short-term, didn't care. I look at this is going to be a win because, as I stated earlier, big national companies are already announcing layoffs. And this is going to be a win because what other industry could you have gotten into and have immediate success? And realtors and lenders got to see that. So you need to make sure that you're partnering up with folks who have the options, right? The non-QM loans, some of those loans, because those are the loans that you're going to start seeing, right? And in our market, guess what? We got no Fortune 500 companies here. So nobody, and here's the big picture, and this is what we're discussing with our clients here at Mortgage Gumbo. Nobody just wakes up and says, you know what, sweetheart, let's refinance today, or even more so, let's just go buy a house. So if you're truly serious about being a homeowner, then you need to get serious. And that's working with professionals, as in the fact of lenders and realtors. And realtors for you, make sure you're working with your lender that's going to be there. That's going to be there. So, again, we're heading for a recession. It's just fact. And my job is education and options here. So we're heading for a recession. Are you prepared for that? Are you prepared for that? So if you've got any questions or anything like that, please don't hesitate. Reach out, 504-207-7600. You could go to mortgagegumbo.com. Got a few questions. Look, we're going to handle those on the off. My job, I didn't want to sit here all day long. So I hope this benefited you. And again, if there's anything you need, look me up. Give me a call. Appreciate it. Y'all have a great rest of your afternoon. Thank you so much. Hey, take care. Bye-bye now. Happy selling.